You always hear on the news, the S&P 500 is up today by X%, or the S&P plummeted after the Fed's statements. This number flashes everywhere. But what does it actually mean? Is it just a boring stock market metric for financiers, or is there something more to it? Why is this particular number given so much importance? Why do trillions of dollars and even our pensions depend on its movements? Today we're going to break down what the S&P 500 is, why it's called the most important number on Wall Street, and why it really matters to every single one of us. Let's start with the very basics. What exactly is this creature called the S&P 500? Imagine a huge basket, but not just any basket, an investment basket. This basket is filled with stocks not from random companies, but from the 500 largest and most significant companies in the US. Apple, Microsoft, Amazon, Google, Tesla, Exxon, Johnson & Johnson, all the giants you know are in there. Well, the S&P 500 is that very basket. More precisely, it's an indicator that reflects the average value of all the stocks in that basket. When they say the index is up, it means that on average, the stocks of these 500 companies have become more expensive. When it falls, they are becoming cheaper. It's like a giant thermometer that takes the temperature of the entire US economy. Because if these 500 companies, which produce almost everything we use, are doing well, then the economy is likely in good shape too, and vice versa. To make this more than just theory, let's look at a concrete example. Suppose we have 3 companies, a large one, a medium one, and a small one. The large one is, say, mega tech, and it's worth as much as 70 small companies. The medium one is Stable Pro, worth 25 small companies. And the small one is Startup Inc. Intaus, with a weight of 5. If in one day Megatech stock rises 10, while Stable Pro and Startup Inc. fall 5, what happens to our hypothetical index? It might seem like 2 out of 3 companies fell, but because Megatech has a much greater weight, its growth will outweigh the decline of the others, and our overall index will show growth. This is exactly how the S&P 500 is structured. Companies are included not in equal shares, but with a weight proportional to their total market value. Apple, with its $3 trillion, has a much greater influence on the index than some smaller company. Therefore, its movements aren't just simple arithmetic, they reflect the real market power of corporate giants. The clear conclusion from this is, the S&P 500 is not just a list of 500 companies. It's an intelligently weighted basket that shows the real balance of power in the market. But why did the S&P 500 become this benchmark? After all, there are other indices, like the Dow Jones Industrial Average or the Nasdaq. The secret lies in its representativeness. The Dow Jones Index includes only 30 companies. They are certainly large and important companies, but 30 is a very small number to claim to represent the entire economy. The Nasdaq, on the other hand, is primarily focused on the technology sector. If tech companies have problems, the Nasdaq will crash, while industry or energy might be doing just fine. The S&P 500 avoids these imbalances. It includes companies from all sectors of the economy: technology, healthcare, finance, industry, consumer goods. This makes it the most complete and balanced barometer. That's why everyone from traders to the government looks at it first. And this brings us to the key question: what does this index have to do with you personally? The answer is a great deal. You may never buy individual stocks, but in all likelihood, you have already invested in the S&P 500. How? Through your pension. A vast number of pension funds, insurance companies, and mutual funds invest their clients' money precisely in index funds that replicate the composition of the S&P 500. This is considered one of the safest and most reliable ways to invest for the long term. Simply put, when the S&P 500 rises, the pension savings of millions of people also grow. That's point 1. Secondly, the movement of the index influences investor sentiment worldwide. Strong growth instills confidence. Companies start investing more in development, opening new factories, and hiring employees. A sharp decline, conversely, causes panic and can slow down economic activity. Thus, this number is directly linked to the health of the economy in which we all live and work. Let's solidify this with a real-life example. Remember the 2008 crisis. The problem started in the mortgage market and with a few major banks. But how was this reflected in the big picture? It was the S&P 500 that became the mirror showing the true scale of the catastrophe. The index fell for many months, losing over 50% of its value. It clearly demonstrated that the problem wasn't with a few companies, but with the entire financial system. Now let's look at the recovery. The slow but steady growth of the S&P 500 in the following years signaled that the economy was gradually healing its wounds. Companies started earning again, and trust returned. From this example, we see a clear pattern. The S&P 500 is not just a number, it's a story of the rises and falls of the American and essentially the global economy, written in the form of a chart. So let's summarize. We've figured out that the S&P 500 is not a random number. It's an intelligently composed portrait of the 500 most important US companies. It's the most accurate thermometer for the economy because it takes into account all its key sectors. And it's a number that affects you personally, influencing your pension savings and the overall economic climate. So, what should you do with this information? First, now when you hear news about the index's movement, you'll understand what's behind that phrase. You'll know it's not just a gambler's game for traders, but a reflection of the health of a giant economic organism. Secondly, this knowledge is the first step towards financial literacy. If you're thinking about investments, then index funds that track the S&P 500 are, for most people, the optimal starting point. It's a way to own a piece of 500 of the world's best companies all at once without the need to pick individual stocks. Of course, this is not a recommendation, but a reason for further research. The main thing is, you will no longer look at the ticker with an indifferent gaze. You will see in it the pulse of the world's most powerful economy, and understanding that is a big deal already. Thanks for watching this video. If you want to continue demystifying the world of finance and markets with me, make sure to hit that subscribe button and click the bell so you don't miss our next videos. Thanks, and see you next time.